Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and I am really excited for today's conversation. We've got with us today Sasha Orloff, who is the CEO at Puzzle, as well as a longtime fintech entrepreneur and founder of some companies that I'm sure you will know and will be excited to hear about. Sasha, welcome to the podcast.
Thanks for having me.
We are going to talk about autonomous accounting. But before we get there, we're going to talk about you and how the world has put you together. So what stuck out to me is, you have a background on the traditional side in the banking world at Citi doing Citi Ventures, but then you kind of went straight into fintech during the industry's early years, like 2012, when the term wasn't even around. Can you talk about kind of the shape of that time, that early time, and then how did you move from, okay, I'm investing on behalf of corporate venture to I'm now wearing the entrepreneur hat and this is the right thing to do with my life. I haven't made a mistake. It's perfect.
So I think a lot of my life has been driven by a couple really fortunate things. One, I come from a family of mathematicians a lot. So I was sort of always drawn towards numbers. I grew up mostly in the Bay Area that always had sort of the waves of web 1.0 and 2.0 and 3.0 all around me. And I was always really curious, and I like to understand and figure out how things work. And so all of those things kind of led me to what do you do in the late 90s with a degree in mathematics and psychology? It's sort of, well, let's go back to the Bay Area and start working in tech. So that's how I started the adventure.
Makes sense. What was it about fintech that attracted you? Like, how did the challenge look like to you? And what were the things that pulled you into co-founding your first company in the space?
Yeah, I was fortunate enough that my very first job out of college was for a startup. It was a company that was being built inside of Benchmark Capital at the time. And we were just moving to downtown San Francisco from their offices. And I was the first kind of kid that they hired. And my job was just to build models and try and understand how the business was working, which was a perfect fit for math and along the way. So we solved problems from building some of the first fraud models on the internet for payment terms. We hooked up the first telephone connection to the internet before there was voice over IP. So you could actually sort of use the internet and phone simultaneously. We built one of the first billing systems on the internet. And it was a perfect skill set between like fraud, I think, payments fraud especially, is like such a great skill set of a degree in mathematics and human psychology. And so that was really fun. And so it was the early days, right? When payments were first starting on the internet. In fact, I think we were the largest payment processor for about a month before Amazon really kind of started taking off. It was a ton of fun. So I think that just, influenced my desire to see the power of what financial services could do and technology in literally the kind of infancy of the merging of technology and financial services together. From there, I read a book called Banker to the Poor, written by a guy named Muhammad Yunus, who later won the Nobel Peace Prize for starting effectively a social bank in Bangladesh. And we tried to replicate that around the world. So I was on the technology team building software, both open source and proprietary, to help kind of small rural banks do this concept of microcredit, small loans to poor women in rural areas to help them start businesses. And that's where you start to see how technology can actually impact people's lives in a very positive way. And then from there, went to Georgetown, got my MBA, worked at the World Bank on the sort of the global fintech and technology team. And that was really fun. You got to see how technology could impact things in countries and how countries were impacted by their infrastructure. And that was really fun. And then went on to Citigroup. And in the ventures team, one of the funny things was it was kind of the very early days of fintech. It was the early incubation of companies like Stripe and LendClub and Square. And I sort of really got to see this firsthand when it was just a few people starting off. And you could just see the wave happening, how software was going to really impact and make all of these products just meaningfully better than anything that had ever existed before.
You were out on the West Coast doing that. Is that right?
Yeah, I moved from New York to Palo Alto. Citigroup was the first bank that started a corporate ventures firm back when there was just really almost no corporate ventures. And so it was really great. We got to see a really broad swath. And so I was in Palo Alto. And so I was seeing all this innovation happening around me. At the same time, I was learning the venture capital, how it worked. And then at the same time, I was meeting entrepreneurs and realizing that it was possible. I never really viewed myself as an entrepreneur. I sort of thought the transition path would be I would be a VC and I would go work for a company that I thought was cool. And I got really just compelled with a vision and I couldn't put it down and I couldn't find a team that was attacking it. And so that was the beginning of my foray into entrepreneurship.
I bring up the West and the East Coast divide because I remember that time as well and what it felt like in New York, in 2010, 2012, where there was literally 5 VCs maybe looking at the space on the East Coast, Citi being one of them that were credible. Most VCs were generalist and fintech as a sector didn't really congeal yet into a big theme. It was woefully underinvested. It was something like 2% of all venture while being 15% of GDP. And at the same time, there was like this feeling that, the Wall Street firms were so big and so powerful and the startups were so little and so meek. And then there was this like kind of natural divide in New York between the skyscrapers and people trying to build things out of a WeWork. Whereas I feel like on the West Coast, the culture and the possibility of things was really different. And I ended up getting stuck in New York and then went to London. But I'm really curious kind of like, I guess fintech's spread out with things like Wealthfront, Stripe, and maybe bigger bets were in the making. So what was that idea for LendUp? What was the exciting thing that nobody else was doing?
So there were 3 things. Sounds kind of silly to say in 2023, but in 2010, 2008, 9, 10, there were 3 huge inflection points that were happening all at the same time. The smartphone, which is now the default, was still a question of whether that was going to take off. The cloud, which meant you could now do massive processing not on device. So you could now sort of effectively put machine learning into production. And the subprime mortgage crisis, which was going to reshape all of the financial regulation and effectively take banks out of ideation and R&D. And they were only going to be able to do things that were sort of tried and true and prime. So it focused on wealthy people again, not sort of the Main Street America. So when you take all of those things together, I got obsessed with this idea that you could lend money on a mobile phone to anybody, and you could use machine learning to process this new data that was becoming available with APIs. And it hit product market fit so quickly. And what ended up happening was we ended up sort of thinking about it as this core technology, and we applied it towards different industries. So this ability to, on your mobile phone for the first time, underwrite, they let somebody apply, underwrite, and give them money in a matter of minutes. And so we started with replacing or creating a better version of a payday loan, sort of turning the concept of a payday loan from a debt trap into an opportunity to build credit. That hit product market fit so fast. Then the ability to do installment loans, then the ability to do savings accounts on a mobile phone, which was such a novel idea. And then the first venture-backed credit card company called Mission Lane, which again also just exploded. I think is the fastest growing, one of the largest credit card issuers now of all time.
Who were the early adopters of this? Where did it click?
The value prop from a mobile phone of needing to borrow emergency money because you got into an emergency. That's basically the premise of the concept of a payday loan, which the structure of the product is awful in the market today. But the concept is I have a problem. I busted a tire in my car on the way to work. My bills are late. There's a timing mismatch between when I get paid and when my bills are due. These are the core problems that we're now facing over half of America. And now the way that you had to do it is you had to either drive to a bank was never going to lend you money, or you had to drive to a payday store and wait in a long line. But now you could just pull out your mobile phone, apply, and have money deposited directly in your bank account in the fastest in a matter of minutes, and the slowest the next day. So that resonated really quickly because it was convenient, it was safer, it was cheaper, and it gave you a path to start understanding. So we built all this education into it. that just took off really fast. We got to 100 million of revenue in about 3.5 years. We grew double digit, even sometimes triple digit month on month for about 5 years in a row. And then we concepted a couple things off of that to a micro savings account, one of the first sort of like neobanks. And then we saw the opportunity for people for a better product was basically a credit card, but a credit card that taught you about how to use it to build your credit, taught you and incentivized you to pay off your bills instead of revolving and paying fees. And that just, again, hit product market fit fast because post, the word subprime is just it's a number associated with some mathematical formula that predicts your likelihood to repay. But half of the country is subprime. And if you're subprime after 2008, basically banks were avoiding you at all costs because regulators would add a bunch of scrutiny. So it meant half of the country now was only really served mostly by Capital One. And they just were not able to, as a single bank, serve the market. So we thought there could be 2 to 3 more Capital Ones possible in the market. It turns out that was true.
To just double click on that, because I think it's so profound, 3 things come to mind. Number 1 is the distribution advantage you get of having access to the solution to this problem of payday loan or on-demand credit or credit building, whatever it is. Just the distribution advantage you get from being on mobile, right? So huge platform shift, lower friction to get to a product. The phone is a much better store of financial products than a bank branch or some grocery store, right? So like there's that distribution bit, number 1. Number 2 is the actual underwriting. So you said machine learning. I'm sure at the time it was, statistics or data science or whatever. Number 2 is sort of the manufacturing of the product of like the engine of like, this is this loan portfolio that you're building over time with this particular credit exposure and the rate of defaults within that. And then number 3 is the actual capital, like the flow of the money from investors into these lending uses. Can you talk a little bit about like, did you play in each of the 3 buckets, or was it like, oh, the distribution advantage is so amazing that we're going to lean all the way through? Or was it that using cloud, you can do the underwriting so much better? Or like, is the capital outsourced to a bank or a group of investors? Like of these 3 levers, which ones do you feel were maybe the most meaningful, or in which order did you press them?
It was Justin Kahn or somebody started popularizing like the first-time founders care about product and second-time founders care about distribution. I probably fell into that bucket. I thought about product the most. Distribution, when it hit, it became all-encompassing. You were scaling so fast that you're spending the majority of your resources just supporting the natural growth that's coming. I think throughout the whole process up through 100 million of revenue and beyond, about 30% of all of our traffic came from word of mouth. It was sort of the product-led growth benefit when your product is just truly that much better. And so that became all-encompassing. But I would say the original insight came from my curiosity at Citigroup. I really wanted to understand how credit worked. And so I spent a bunch of my time working in operations and working in underwriting and working in modeling and working in finance and marketing. And one of the key insights that this slightly funnier story is, so my brother grew up as an engineer in the Valley. At 16 years old, he started at Yahoo as an engineer, and he worked at Yahoo and Zynga. And now he is head of infrastructure at Cruise Automation. He was my co-founder at LendUp. And so I was working and I was curious. And so the one key insight that I think was interesting is at Citigroup, because the technology was so old, to do underwriting, we only were allowed to use 13 variables in our model. And it had to be regression. And so that's pretty limiting. In regression means you can only use one effective data source and 13 variables, because that was obscene at the time that a system of underwriting would allow you to have 13 variables. That was unheard of, but it became the bottle factor. If you can only use 13 variables in regression analysis, you can only do such a good job underwriting. And you really only are effectively working really well for prime people that have a very thick credit file. If you're working with half of America that doesn't have a credit history at all or a thin credit history, a regression model on one data source with 13 variables is just not enough to do effective underwriting. So I would go home for holiday meals or vacations, and my brother would constantly say, that's a software problem. And I just didn't resonate. I was like, no, it's a modeling, it's a software problem. So finally, when we decided to co-found LendUp and Mission Lane, we built the software that would allow us to do machine learning across multiple data sets. Because if you don't have data about somebody, your decision effectively is no. But everybody has cash flow data, and there's all these great alternative bureaus with rent payments and phone payments and identity that is just not available in the traditional bureau. So I think to me, that was the insight. Our fraud and our underwriting capabilities were unmatched to the industry. We know this because we had a bunch of banks do independent analysis against other banks, and we consistently had lower combined fraud and credit losses to a better approval rate than anybody else in the industry.
That's awesome and amazing. I mean, I just remember the counter argument at the time, which is not right. The counter argument at the time is that, look at these banks. They've been around for 150 years. Or like, look at this insurance company. It's been around for all this time. Like, they have data on every market cycle. And how could a startup from a starting point without all of this historical knowledge, like, replicate the accuracy of their underwriting engines? And, at the time, that's what it sounded like. And that's a scary wall to face. Like, yeah, maybe they do have all this data and millions of customers. And then end of the day, like, good mathematics is just good mathematics.
There's some people who are just, I think, pure visionaries, and they can create things that don't exist in the market. I never would think of an idea like an Instagram or a Twitter. That's just, but what mathematics is really good is like optimizing software mathematics. It's really good at really understanding the truth and finding ways for efficiency. And so if you have the time to be able to study these trends like VCs do, and you have the privilege that I was in to be able to take that first step towards entrepreneurship, because I had a wife who likes stability in her job and could pay the bills. We didn't have kids at the time. You can look for these great inefficiencies and places where software can truly have a major inflection point. And when you hit it right, it feels like you have this kind of the secret that nobody else sees and understands. And if you can convince the market and enough capital providers to give you the money, you have this secret that it feels like nobody else can see. And that was what it felt like at Mission Lane and LendUp in the early days. And you just never know when the market's going to catch up. And to date, it still really hasn't. And I think you'll see as we start talking about Puzzle, I think you'll see a lot of those same themes in accounting software, which is literally 30 and 38 years old, controlled by effective monopolies, sitting on technology that is generations ago. And they're just not positioned in a world that is changing so rapidly and with the advancements of LLMs so quickly. I think later in the podcast, we'll hear a couple themes that are identical.
It's the perfect time to make the transition about the sort of the echo that you're experiencing in these two different startup experiences. I feel like Intuit is a thread through your DNA, maybe in some way. What is Puzzle, and what is it that you saw that brought you to Puzzle? You went from the credit space into the accounting space pretty directly. What kind of things started to become visible or appear inevitable for you to make that choice?
Yeah, it seems a little bit more inevitable now than it potentially did at the time. But I think if we take similar themes to how can data and math, can they create a competitive advantage? So who knows whether it's I found accounting or accounting found me in that cross section. But at its core, I think what we'll see is the way our key insight was this streaming real-time financial data platform and a general ledger, which is basically the structuring agent for accounting, the thing that creates the financial statements like a profit and loss or income statement and balance sheet, that these two things together are actually more powerful than apart. And so if we take a little bit about looking at accounting, it's required by every business because you have to file taxes every year. If you happen to be a business that's going to fundraise, you need to have a certain set of financial statements that are called accruals, which is what investors really like. You also use accrual accounting for tax mitigation strategies. But these are kind of these future problems. And the problems that people care about today in such a crazy volatile funding environment, macroeconomic, is you care about understanding your cash and how your business is using its cash to create your business today. And that's called cash accounting. And previously you had to choose. You had to choose either cash accounting, that's usually QuickBooks, or accrual accounting, that's usually NetSuite. And what if you could only not have to choose. You could have both because you need to solve this future problem. You don't want to dig a ditch and then not be able to have a cool accounting for fundraising or for taxes. But you need to understand your cash and database. If we could do this, then what we can do is we can make accounting real time. We could make it relevant and we can make it scalable and much more automated. And when you layer on top how fast LLMs, specifically GPT-4, has come, you now can unlock capabilities that were just not possible before. So we could never predict the timing of AI. But for example, GPT-3 and 3.5 couldn't pass the CPA exam. GPT-4 just did about a month ago. And so that makes it right now the most exciting time for anybody that cares about choosing accounting software.
I want to draw a couple of things out. So tell me if I'm wrong, but one of the things that seemed to power your earlier entrepreneurial experience is being able to access large amounts of financial data, right? And so things like Mint, Yodlee, now Plaid, and so on, it's kind of generations of making financial data available. And then you've described how on top of that data, you can put machines that can manufacture financial products, i.e. the underwriting engine, and then how through the right platform, you can get unfair distribution, put it that way. There's an analogy to the accounting world here too, because you have that same data stream of underlying information just focused on, SMEs, and the manufacturing is different. It's not for debt here. And you've listed a couple of use cases, whether it's fundraising or, tax mitigation or filing, and those can be transformed as well. I want to go into that, but I want to kind of look back and get your reflections on some of the things that I've kind of struggled with, which is, in that moment where you had the financial data explosion, I remember there were so many attempts there were various permutations of accounting software. I, in fact, remember I used Wave for a couple of years in the early days of my robo-advisor startup. And then there were a few things like Money Desktop, which kind of packaged all that stuff for bank customers and sold it as private label. Kind of my conclusion on all that stuff was that it had a bump. It was sort of in the PFM industry sector. It had a bump up until maybe 2014 and then dissipated. You're attacking the space with very different tools and going higher up in terms of the value proposition. But I'm curious as to your thought, having been somebody who really looked at that stuff at the time, like what happened? What were the mistakes that people made and what's changed?
That is something I've thought about for a very long time. And I don't know if I have the exact answer. What I will say is my thoughts on how it related to building Puzzle was this knowledge, like the Plaids of the world, which Intuit, actually we were one of the first customers of Intuit's version, which was the original one before Plaid came up, was really, really powerful. It unlocked a level of data that made things like Mission Lane and LendUp possible because everybody has cash flow. You can see if somebody has a job and an income, which that information just was never available. If we think about what the analogy is today, think about how powerful Stripe replaced Chase payment tech. If anybody was back in the day trying to do a payment processor, it was a long, painful process that resulted in a no. And you have Mercury allowing the first bank with an API to exist, which now means this data is now reliably available and additional data. Rippling and Gusto, similarly, payroll providers that are API native have all of this additional data. Ramp and Brex really leading the forefront from spend management with APIs. All of these are replacing these legacy players that this data wasn't available. If it wasn't for those in the Plaids of the world, something like autonomous accounting would never be possible. And so I think there's a theme there in the availability of data with automation. I think the second piece that I think is relevant, or how I think about it, is PFM really is a nice to have. Accounting is a requirement. If you are starting a business, you have to have an accounting system. And so I really like both PFMs and accounting. It's similar, the same thing, taking financial data, effectively your cash movement, and figuring out what's the current state of it and what does it mean. But it's not, you don't have to have a PFM, but you have to have an accounting software. So that I think is one kind of key difference that struggled. And then the next piece that I think is like really interesting is, in my view, I think the majority of people for accounting and for personal financial management, when you get to a certain level, it's so complicated and there's so much knowledge that's needed that it's not really ever going to be just pure software. And I think when you combine software as sort of the autonomy layer with somebody that is trusted and knowledgeable, those things become really powerful. You get the best of both worlds. You get a better product for a lower cost. And we're seeing that the same thing. Like accounting is predominantly like founder led and then accountant led and then CFO led. But you still have, there's all accounting is a part of an art and a science, or building this is part art and a science. And you kind of want the best of both worlds. But paying somebody to do just the day-to-day tracking and management and understanding, that's like not a good use of human time. And it's not a good thing that people want to pay for. So I think that's where we see like the really power of personal financial management is the ability to do it and then understand what that means and be able to make effective decisions. I don't know. What do you think?
Yeah, it resonates. I think one is just to some extent, consumer behavior and consumer adoption wasn't ready for it. So like, even though I was happy to use like the totally fantastic and free Wave accounting software, like I'm sure most people were still printing stuff out, or scanning them in and giving them in a folder to accountant office. So I think there's maybe just like early adopter problem. Although it's surprising, you'd think it would be a huge take up. The other thing that you said, which is that it's a vitamin, like the utility from it is really low. I think there's pretty good evidence for that, right? So PFMs on their own for a while were the lead generation candy for other products. So with like what I was doing, and then Personal Capital had a very similar model. The PFM was like, hey, come look at your net worth. And then if you want to do better than what you're doing, convert into investment product. Very natural sale. Or on the credit side, right? It's like, hey, come and track your credit score and you'll get credit offers to improve this or that, Credit Karma and a bunch of other things of that shape. And so it was presumed that like the customer acquisition cost would be paid by offering people the PFM, and then some percent would convert into the financial product. And I think that got really stressed. Like once PFM became free everywhere, it just became this arbitrage of, where are you moving your free investment or financial tracking? Like which website is going to subsidize you until their venture funding runs out? And to me, it felt like the value prop of the PFM was pretty incremental. It wasn't the value prop of, I'm going to solve your entire, accounting workflow problem, or I'm going to solve your entire debt problem, or not entire debt problem, but like your particular credit need of this point of time. It's more of like ambient anxiety inducing information. So I think the machine that you build out of it is much more important than just having access to the underlying information. So let's double click on the puzzle machine. What is autonomous accounting? What does ChatGPT have to do with it? What are you all working on?
I want to bridge my answer with something you kind of just said. So for PFM, there are people who it adds an extraordinary amount of value. Then you can see that by like Copilot is a paid PFM. Like who would have thought in the history of PFMs that people would pay for it? And they have a huge following and a great product. But I think the important point is something underlying what you said, which is the alignment of your product and your revenue model. If those two things are out of line, it can create stresses to how you prioritize what you build and the things that you really you want.
I hate to interrupt you in this, but I think is just an important point to make, which is I am one of these people for whom PFM is really valuable. Like I love it, having it all in front of me and done. And if you're a founder, being idiosyncratic that way can be really damaging in the sense that you might like something really obscure and then you project that out onto the world. And in fact, it's just a bunch of you weirdos, putting things in Excel. It's not the normal person.
Yes, totally. I'm one of those weirdos and I love it. But all right, well, let's kind of talk about why autonomous accounting is possible now. And so I'm going to set a bit of the foundation to why the market has changed now. And then I'll talk about what's the problem that we're solving today. And I think it will tie back to hopefully something interesting. So Today, there's three kind of, I think, really good trends that we've talked about, but I want to bring it together. So we have current monopolies that were built 30 and 38 years ago that are solving this problem for the overwhelming majority of our industry. So we have now, one, the popularity of these API finance software like Stripe, Gusto, Rippling, Ramp, Rex, and Mercury. This additional data can now automate categorization and reconciliations, which can make accounting real time. We now have improvements in artificial intelligence, and GPT-4 was a breakthrough in LLMs, at least for our industry, that can now enable business leaders to perform accounting tasks without accounting knowledge. And again, that will come into your accounting and your financial insights. They're only relevant as the accuracy of your data, and GPT-4 is tremendous in this. And the third, which is a little bit subtle, has been building for a while, is the profiles and the demands of founders and CFOs have changed. So startups can now scale faster than ever before. And that means you want real-time information to be able to quickly adapt as fundraising markets change. And we go from revenue to profit and cash flow to extending runway to scaling globally. And modern models require additional financial metrics and analysis, meaning if you're a software company versus a manufacturing company, you need to see ARR and you want to see burn and runway and cash flow and drivers of cash flow. And you want to see these other metrics, magic number, burn multiples. That's not available in your financial statements. And right now, because Stripe and Gusto, Rippling, Ramp, Rex, Mercury are so much better, people are using them. That means your data is more siloed. And what that means is the most valuable person on your accounting team is the one that knows how to code. The implication to that is there's a problem with our software. You should not need to be an accountant that needs to know how to code to do your job. You should not be a finance person that needs to know how to code to do your job. That is a problem of not of accounting. It's a problem of software. So how do we make this a real-time system of financial intelligence with highly accurate data? Right now, if you're a founder, think about just the starting point as a founder. You've been through this. Every founder listening has been through this. Every investor that is investing in ambitious founders is going through this. When you first set up your company, you have three pretty bad choices in the world of accounting. You get to adopt all this really great software, and then your choice is this like 38-year-old piece of software. So what you either do nothing, then you're really out of compliance. You're basically just digging a big hole later. Two, you have to learn how to be a bookkeeper. Well, that's not a great use of founders' time or early company time. Or three, you have to hire an expensive bookkeeper, and you're really generating these accrual financial statements, likely in the estate. That's really expensive. And it's a big part if you've only raised like you're bootstrapping, you've raised 100,000 or 200,000, having this like really expensive bookkeeper to maintain accrual books from day zero is just, it's a lot of money. So now with autonomous accounting in 2 minutes, any founder without any expertise in accounting or finance can set up, have compliant, scalable books. And you not only get your financial statements, which you need for fundraising and for taxes, you also get the first complete real-time insights about where all your money is going. You can see all of your spend. You can drill down to the transaction. You can see the receipt on the transaction. You can see every invoice, every customer. So it makes it now approachable and understandable because you can understand everything. And if you don't understand anything, as long as you know how to click on your mouse, then like you can drill down into, you don't need to know what gross margin is. You can just, we structured for you. You can trace down to see what your gross margin is. You don't need to know what your burn is. You can literally trace down your burn and you see it in real time. And then we can do all sorts of other cool stuff on top of it. But that's basically what I get so excited about.
So I understand what it's like to pull in a bunch of data through APIs. I don't understand how an LLM is used, how, a chat GPT version can be used within a piece of quantitative software. And I think that mold hasn't really been defined yet. Like we're right at the starting point of flat software starting to incorporate natural language into the interface and then into the data models and so on. How does that work? How does it work in terms of the back end? And then how does it work in terms of the user experience?
Yeah, this is fun. All right, let's get into some specifics of how this actually translates into something different. So I'll give three examples. The first one is back to the data. So if you are just looking at your, like, say, bank statement, you might see something that says check 123. Well, it's really hard for anybody to know what check 123 means. But so if you are able to now understand and see the check details, the check images, this works the same for invoices and bills and receipts. You can see who spent it, where they spent it, what it was spent on. In the credit card, you can see the MCC code. You can see any notes or annotations. You can see any of that. The sort of extra metadata exists. You can do a better job of categorizing what that is without any human involvement with a higher confidence. This is just the passing of additional data from places like Ramp, Brex, Mercury, etc. So one is, by having more data, you can make a higher confident decision. So if we think about accounting not as a binary thing anymore, so accounting is typically binary. It's either all done or not. If we think about it from the terms of confidence levels, you can have a higher degree of confidence by having more data. Same thing goes with, say, this is where, let's get to a specific example about how LLMs can come into play. So if you're an accountant today, what you would do is you would see this transaction from, say, Amazon. Let's say Apple. Apple is like maybe a computer. It might be a phone. It might be a case. It might be a pen. It might be something else. You don't know where that fits into your chart of accounts, which is effectively the categories of accounting. So how do you increase the confidence aside from just something that says Apple? Well, if there's the receipt, that really helps. If there is the notes, that really helps. But if there's none of that, that's where LLMs can really come into play. You no longer need to know what your GL account number is, general ledger account number. You don't even know that it's like 6500410 to know that that's what computers and hardware is. And you don't need to know that that probably goes on a balance sheet and needs to be depreciated. We can just tag right on the transaction. So a bookkeeper or the system in autonomous mode just can tag and say, we know, because we're accountants and engineers and software and mathematicians, that Apple is undefined and unknown, and we see there's no receipt. So it just shoots a Slack message or an email to the user, and it says, hey, reply back and tell me what this is. The founder, let's say the founder bought it because we know who the cardholder is and it's the founder. They can just reply back and say, oh, this was a computer. We just hired Lex on the team and we shipped him a computer. Cool. Well, so what GPT can do is, through a bunch of training, we can help it understand how that relates to which chart of accounts it is. In this case, it doesn't just go to computers and hardware as an expense. You're going to depreciate it over time. So it goes over to the balance sheet because we own the general ledger. We build our own general ledger. So all you did was say, this is a computer. Our system interprets that goes on the balance sheet as an asset, that it looks for what's called an accounting policy. That's how long do you depreciate for? Let's just say 3 years. It depreciates it for 3 years, puts it on the balance sheet as an asset, and every month it expenses that computer divided by 3 years over on the balance sheet. You don't need to do anything. You don't need to know anything about accounting. You don't need to know any GL account numbers. Our system knows to look for a policy, interpret it, put it on the balance sheet, not on the profit and loss statement, and start depreciating it. So you get to see it on a cash basis and an accrual basis at the same time by just saying, this is a computer.
That's awesome. One more finer point on that. Are the rules deterministic, or are they executed based on sort of the statement that ChatGPT is better than the average CPA, or knows as much as, can pass the CPA exam? Like, is it that you've written a bunch of rules like, when object categorized as a computer, then do this? Or is it somehow passing through the probabilistic cloud of the LLM and, you're mapping its output somehow?
There's definitely a set of just rules and automation that are built into it. So the difference between buying office supplies on Amazon is pretty easy. That it just goes to office supplies if we know that those are office supplies, or something that is gas expense. Now, there's certain things that are very accounting specific, like, is an investment preferred stock? Is it a convertible note? Is it a safe? Is it common stock? Is it a price round? There are certain things like travel and entertainment that have different tax deductions that are based upon whether you are traveling, whether you're having meals or entertainment with clients, with employees, or just by yourself. So I'd say there's a combination of software rules specific to accounting combined with LLMs to make that workflow feel very magical to everybody involved. But what is the potential now that GPT-4, for example, as an LLM, as generative, can now oversee accounting? What it means is it will be able to help you better predict what accounting categories these go to. It should be able to better predict when you're doing something out of a normal pattern recognition. It should be able to smooth the workflow. So there's a cafe in New York called Grey Dog. Like if you Google Grey Dog, you're probably going to get a bunch of pictures of Grey dogs, right? But it happens to be that we know it's a car, we know it's somebody traveling, we know who the person is, we know they're in New York. We can now pull that in to provide greater context in what is the vendor, what are the potential classifications, what are the tips for accounting, and all that can be done sort of thinking about accounting as a set of policies, a set of rules, can validate whether those rules are being enforced appropriately. But we're still in the early days. So I think there's a lot more is going to change if we think 1, 2, 3 years. This just happened a month ago. And so we're just jumping on its new capabilities pretty quickly. Does that answer your question?
Yeah, it does. It's really interesting. I think it goes to like a broader science fiction question of what the shape of intelligence looks like and what the shape of AGI looks like. In some sense, like these deterministic rules, yes, in this case, they are for accounting, but I think there's lots of things in our world that are specified, are kind of like the chassis. They're the skeleton. And then the probabilistic models, the fuzzy ones, they're like the organic matter on the skeleton. And I know that in the history of AI, you've got these attempts at knowledge systems, which actually characterize things in some particular structure. And then the popular models now are very fuzzy. They're sort of self-forming and organic. I don't know. It's just something on my mind of like how much of our software building and how much of our productivity, how much of that will continue to be very specified versus how much of it is just what the abstraction of the LLM will reflect back to us.
I think that there's one nuance here that I think is slightly different in accounting than in other systems that differentiates like the generation of a blog post or the generation of an image that is potentially different and a little more scary, but also exciting in the world of accounting. Is accounting has a certain set of rules, the generally accepted accounting principles, like GAAP. There also happens to be personal liability for founders and directors. And so anytime you have something that has personal liability because it's the IRS and they want to make sure you're filing taxes and filing it accurately, and fundraising, you want to make sure that you are reporting accurate financial statements. There's going to always be a need for human oversight. But what it can do is in the different stages of a company, founder-led, that's pretty good enough. It's better than doing nothing. And we see if you use a modern set of tools, about 98% is done fully automatically without needing almost any intervention with humans. And that's better than either doing nothing, trying to learn how to be a bookkeeper, or hiring a really expensive bookkeeper in the early formation days. But then even if it's bookkeeper-led, you've hired an outsourced bookkeeper, you've hired an in-source bookkeeper, they now can control all of the AI and it's fully auditable. They have the settings to be able to decide how much they want. Even still, what we're seeing is, and we need to build case studies to validate this, what we're seeing is it's reducing the time it takes to generate books with an expert in upwards of 80%. Probably, if I had to put in writing at some point, probably put closer to 50. But if you're really doing everything pretty standard, you only really need somebody to deal with the brand new stuff that's never before been seen. So you think of it, you have this like AI bot learning everything the accountant's doing, implementing all of the policies, enforcing all of the policies. So what you can do is you can now really hire a much senior person for a much more affordable cost, because literally they're not categorizing Google ads 5 times, 10 times, 15 times per month, or thinking about, do I need to create a rule for every time I do something, or do I need to create a rule for every portfolio company? It just learns and does it automatically. So it gets more and more efficient and effective over time. And then when you're at the CFO-led part of a company, you're really truly thinking about resource allocation in a company. Where are you putting your people's time and where are you putting the money of an organization? And is it impacting the way that we expect? And in there, that's where this sort of system of intelligence, I think, will really transform and help people think about different scenario analysis and think about things that you normally had to ask a question, have somebody else then interpret the question, have somebody else write the code, have somebody else go through and find the data, have somebody else go make sure the data is reconciled and validated. You just have this data platform that's immutable, append only, traceable, justified, has all the backup information. I think you can now connect questions to answer. You'll be able to connect questions to answers a lot faster. What's my budget? How am I doing? Is this ROI? Did this marketing have the impact we thought? Well, you can now have a higher confident real-time answer because you have a real-time data platform that's been reconciled and validated and learns and gets better all the time. That's where I think this is going, and I'm pretty optimistic that it will make accountants and CFOs much more relevant in the day-to-day building of an organization. And it will make founders a lot happier, and it will increase their confidence in building their companies bigger, better, faster.
Fascinating stuff. And I think it gives us also a preview of what labor looks like in a world where we have fully powered LLMs and they're starting to get deployed into different industry niches, and also kind of pointing out that hybrid work model of like, yes, you have a person in the seat, but you also have a highly trained, specialized robot agent in the seat alongside with them. I'm really looking forward to seeing how the company evolves. For everyone listening, could you share where they can learn more about Puzzle and about you?
Puzzle.io, Puzzle.io, has a bunch of information. If you're a founder, you can literally get set up in 2 minutes without any expertise. We love hearing feedback of how we can make this better. And so that is, how do we get a hold of me and the team? There is an intercom everywhere. There's a how do I make this better button on every single page in our entire experience. I'm on LinkedIn, Sasha Orloff. I'm at Twitter at Sasha Orloff. I'm pretty responsive within a couple of days. We love feedback. We love unfiltered feedback. We're building for the community. So let us know what else we can build for you.
Amazing. Sasha, thank you so much for joining me today.
Thank you. Thank you for having me.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.